Can you see my screen? Confirm if you can see my screen.
You can see your screen, sir.
Yeah. Good morning, everybody. How was your weekend? Your week, rather.
It was fine, sir. Thank you.
How are you, Prosper?
I'm fine, sir.
Good. Okay. We continue where we stopped in our last class. Emmanuel Oladipupo, I agree to you. Victor, I agree to you. Fidelis, I agree to you. Who else in the class? Believe, I agree to you. Judith, I agree to you. All right. So let's continue from where we stopped in the last class. In our last class, we're actually talking about capital allowance, and I'm very sure by now every one of us have a little bit of understanding of what capital allowance talks about. Now, just like you have said, I've said initially, I said capital allowance is allowance granted in lieu of depreciation. That is, instead of granting depreciation, capital allowance is allowed by the tax authority to stay. And I've given reasons why depreciation is not an allowable deduction. Now, having said that, we'll quickly move on to basis period for capital allowance, where I told you that the reason for introducing basis period for capital allowance is for us to be able to allocate the asset to the relevant year of assessment. Now, when an asset is acquired, there's every possibility that we might not be able to know where that asset will be allocated. Therefore, the tax authority, in their way, introduce again basis period for capital allowance, where you'll be able to use that basis period for the purpose of introducing your assets to the relevant years. Now, I also told you that not all assets are qualified for capital allowance purpose. There are some assets that are not qualified for capital allowance purposes. Why are they not qualified? And I've told you it could be because of the limited nature of the assets. It could be because of company's policy. It could also be because of government policy. Now, when we talk about limited nature of the asset, we talked about um, unlimited nature, rather, unlimited nature of the asset. We talked about the land itself. When you look at land, for example, you cannot categorically put a lifetime or a life useful life to land, because land continue to exist through the generations. Okay, therefore, we cannot really say that capital allowance should be granted on that, because when you're talking about capital allowance, there has to be a specified or specific number of years in which we'll be able to claim our allowance. Thereafter, what will be left is for us to dispose the assets. Now, having said that, we also move straight to when an asset is acquired prior to the date of commencement. We said that asset will be introduced to the company as if the asset has just been acquired on the date the company commenced operation. So that was what we did last class. Last class, we talked about disposal of assets. We said when an asset is disposed, the possibility that the company will be making profit or loss on disposal of assets. However, we also said that when a company makes profits on disposal of assets, we said such a profit is not chargeable to tax in company's income tax. However, again, such a profit, we said it is chargeable to tax under capital gains tax. And I think the next topic Mr. Idris will be taking you guys will be capital gains tax, where he's going to expose you to the capital gains tax. I don't know, maybe he has started it, but I know it's in the pipeline. He was going to start it if he has not started it. Or if he has taught you, I don't know his schedule, but maybe he has taught you or not, I don't know. But again, another thing that we also talked about is when a company makes loss on disposal of fixed assets. Sorry guys, I was a bit of distraction here, so I asked quickly settle that before we continue the class. So as I was saying, I said, so when an asset is disposed, it's either the company makes profit on the disposal of the asset or there is a loss on disposal. We have also said during our computation of our capital allowance, we said, sorry, adjusted profit. We said profit on disposal is not taxable, while loss on disposal of asset is not allowable. But in my last class with you, excuse me, I was able to tell you that when a company acquires an asset and they dispose it, we have to compare the disposal value with the tax return value. If the tax return value is more than the sales proceed, then there is going to be what we call balancing allowance. But if the sales proceed is more than your balancing, is more than your tax return value at disposal, you're going to have what we call balancing charge. And I told you in the last class, balancing charge is always restricted to the total allowance claimed on the asset disposed. So when you dispose an asset, for example, you have to restrict the capital allowance to the amount of the total allowance claimed on that asset. So, for example, if an asset is disposed for 100K and the total allowance claimed on the asset maybe is 95K, and you dispose the asset, you have a balancing charge of 120,000. We are saying that your balancing charge has not been more than total allowance claimed on the asset, which is 95K. So you restrict it to 95K. So that is that for that. We quickly have to now move to balancing allowance. We said balancing allowance does not have restriction. You don't restrict balancing allowance because it is an additional allowance. We talked about restriction of capital allowance in our last class, where we said capital allowance is restricted to the to 66 to 30% or 2/3 of the accessible profits. That would be for a trading company. Meanwhile, for a manufacturing company, there is no restriction to capital allowance. You don't restrict capital allowance for a manufacturing company. But for a trading company, capital allowance is restricted to 2/3 of the accessible profit. Having said this, we moved on last week to carry backward of capital allowance upon cessation. We said where a company ceases operation, such a company has right to carry backward its capital allowance for a maximum period of 5 years before the year of cessation. So that was what we discussed in our last class. Today, we are going to move to the next phase, where we're going to be talking about capital allowance with accessible profit. How do you compute your total profit given this kind of scenario? So we're going to be looking at illustration 10 in the study pack I've sent to you already. So this is DK, is an investment company and has been in trading. I've been in trading for many years, and the company usually makes up account to 31st December in each year. The following adjusted profits / loss has been agreed. So we have year ended 31st December 2023, we have 1.2 million profits. Year ended 31st December 2024, we have 700,000 loss. Year ended 31st December 2025, we have 3.5. Year ended 31st December 2026, we have 1.250. Someone is asking question. Hello, sir. I am new in this class. Okay, Emmanuel. So I haven't seen any material. Okay, Emmanuel, you will get it. You'll get it. Are you on our WhatsApp group? Release your mic and talk. Are you on our WhatsApp group?
Yes, I'm on the WhatsApp group.
You are not on the WhatsApp group.
I'm on the WhatsApp group.
You are on the WhatsApp group. Prosper, we share the material on the WhatsApp group so that Emmanuel can.
All right, so I'll do that.
All right. Thank you. So this is a question. We have adjusted profit. We are given adjusted profit and loss. Now we are also given schedule of fixed assets. We are given schedule of fixed assets. 31/12/2023, 415 10 was acquired, and the amount of the 10 is 1.8. Motorbike 5 was acquired, the amount of the 5 has been given. So what this means is each of the assets, if you divide it by 10, each of which was bought for 180,000. It does not mean 10 multiplied by 1/8. Do you understand me? So that is what that means. So let's go. The examiner asks you, you are required to compute capital allowance for 2024 to 2027 year of assessment. 2, compute the income tax liabilities for 2024 to 2027 year of assessment. So let's go. Now, this asset was acquired in 2023. The relevant year of assessment for furniture and fitting will be what? Based on the fact that this company is a trading company and has been in business for so many years. So what will be the relevant year of assessment for 2023 year end? Prosper.
Sir.
What will be the relevant year for this asset that we acquired in 2023?
Sorry, sir, I didn't follow the question when you were reading. So,
Okay, now I'm asking you that an asset that has been acquired in 2023 with this year of assessment. They gave us 31/12/2023 as our year of assessment. Sorry, as our year end. What will be the relevant year of assessment for this year end?
2024, sir.
2024, good. That means these assets will be introduced in 2024 year of assessment. The same thing goes for motor vehicle. But for plant and machinery, what will be the relevance year, Fidelis? (2025). For asset acquired in 2025 year of assessment, 2025 year end, what will be the relevant year? 2026. Do you understand? So we're going to be introducing each of these assets in the relevant year. The asset acquired in 2026 year end will be introduced for the tax purpose in 2027 year of assessments. So that is it. So we'll go ahead. So the first thing that we're going to do is for us to bring all the assets into our table. Now, furniture and fitting, the rate is 25% for initial allowance. Annual allowance is 20%. Motor vehicle, the rate is 50%. Annual allowance is 25%. Plant and machinery, the rate for initial allowance is 50%. Annual allowance is 25%. Equipment, the rate is 50%, not 25%. This is an error. The rate is 50%. Annual allowance is 25%. So let's go ahead in calculating our capital allowance. Now, in the first year, you remember we bought two assets. We bought furniture and fitting and motor vehicle. So we are introducing them. And this is the basis period. Now, initial allowance is calculated on the costs. So 25% of 1.8 will give you 450,000. 50% of 450,000 for motor vehicle will give you 225,000. These are the only assets acquired in this first year. That is why we are only introducing these two assets in this first year, not minding the other assets because it is not their relevant year of assessment. Now, we need to also calculate our annual allowance. You remember in our last class, we said annual allowance is equal to cost minus initial allowance divided by number of years the asset we use. Now, this motor vehicle, we use how many years? The motor vehicle we use 4 years, while the furniture and fitting, we use 5 years. How do I know? 100% divided by the annual allowance rate. 100% divided by annual allowance rate will give you the number of years. So if I say 1.8 million minus 450,000 divided by 5 years, I will have 270. Calculate that on your own and confirm the number. I'm waiting. As the number will confirm.
Yes, sir. 270,000.
The next one, calculate the next one and confirm if it's correct. Is it correct? Did you get the answer? That is 450 minus 225,000 divided by 4 years. Did you get this? Okay, in the absence of nobody talking, I assume that you got it right. So for my capital allowance for the year, I'm going to have 450 plus 225. It gives me this number. I will also add these two together. It gives me this number. So for this year, the total capital allowance that we have is 1,001,250. Now, my tax return value will be 1.5 million minus 450 minus 270. I will have this number. The same thing goes for this. I will have this number. Now, in 2025, we acquire motor vehicle. Look at it. Is it motor vehicle now? Plant and machinery was acquired in 2025. Plant and machinery was acquired. Look at the dates. So for the year ended 31st 12, 2024, we acquired this. So I am going to introduce it again in 2025, year of assessment, which is 1 million. The rate, initial allowance rate, is 50%. 50% of 1 million is 500,000. Now, on this asset, I need to calculate my annual allowance. That is 1 million minus 500,000 divided by 4 years. I will have 125,000. I will have 125,000. The next one is for us to continue with the old assets. And you remember, one of our classes, I told you annual allowance is constant. Annual allowance is what? Is constant. So, and the only way where annual allowance will be constant is where there is no, your basis period in the first year of acquisition of the asset is not less than 12 months. So annual allowance is constant. So I'll just repeat my annual allowance I have here. That is, I'll just repeat this and bring it here. Again, you can also say this asset is supposed to use how many years? 5 years. And it has used 1 year. I'll just say this divided by 4. I will have this. This is supposed to use 4 years. It has used 1 year before. Now I'll just say this divided by 3. I'll get this. Do you understand that? Okay, I assume you understand it. So I will also get my annual capital allowance for the year. I'll bring all the annual initial allowance together. I'll bring it here, which is 500,000. All the annual allowance added together, which is 451,250. If I add it together, I have 951,250. Again, I will have tax return value, which is 810. I also have tax return value here, which is 11250. And I have tax return value here, which is 375,000. That is 500 minus this will give you this. Sorry, that is 1 million minus 500 minus 125 will give you 375. In this place, I will have 168,750 minus 500 and minus 56,250. I will have this. The same thing goes for this. This minus this, I will have this. Again, in 2026 year of assessment, additional motor vehicle and furniture and fitting was acquired. Look at it. We acquired another one, furniture and fitting. We also acquired another motor vehicle. So I will introduce those new ones as cost 260 and 640. On the new acquisition, I am going to have my initial allowance calculated. So initial allowance is 25% of this for furniture and fitting and 50% of this for motor vehicle. I will have these numbers for the new asset because initial allowance is calculated once throughout the useful life of the asset. And I'm going to calculate it on the new asset. So that's what I've done so far. So I will add this together. I will have 385,000. Now for my annual allowance, now don't forget that we now have two assets that we have joined together. We have the old annual allowance and the new annual allowance. Let's see if the calculation is somewhere here. Okay, I did not put it there. Let me tell you how we got this 305. 309. 309 is gotten like this. Let's go. Let me put my marker on. So I will have 260,000 I cannot use marker again. I'm coming, guys. Okay, I've seen it. So I will have 260,000 minus, I'm calculating the annual allowance of the new one, 65,000. The asset is supposed to use 5 years, divided by 5. What do you have? Give me the value. Give me the value. Let's make the class active now. Why are you guys not talking?
Sorry, 39,000.
39,000, thank you. Please, let's make the class active. Don't just keep quiet when I'm asking you a question. Let me know that you are following. 39,000, right? Now, the old annual allowance that we've been carrying, that we have before, was 270,000. Abi? So
Yes,
if I
sir.
add 270,000 plus this, I will have 309,000. That's how we got to 309. The next one is the new assets, new furniture, sorry, new motor vehicle. 640,000 minus 320,000. The asset is going to use how many years? 4 years. Divided by 4. What do you have? 80. Abi?
Yes, sir. 80,000.
Good. It seems that we only have Prosper in this class. That's not right, though. No issues. Now, Judith, you are just keeping quiet. No problem.
I'm here, sir. I'm here.
Okay, oh, no problem. So we have 80,000. Don't forget, on this old assets, we have a taxing down value of 112,500. And we also have, I told you annual allowance is constant. So if we have, the annual allowance for the old asset is 56,250. 56,250 plus 80,000. If you add the two together, you will have 136,250. That's how we got that. So these assets is still the old one. There is no additional asset on it. We did not acquire any other one. Unlike these ones that we acquire additional asset. We did not acquire any assets here. So the annual allowance should be constant, which is 125,000. What we had in the previous slide. So what we had here, you remember, we had 125,000 here. So that 125,000 is still what we are going to bring down here. Any question? So again, when we are done with that, we also add these two together, we bring it here. We add these three together, we also bring it here. And the total will be 5,955,250. We go ahead. The tax original value in 2027 is 697, that is 810 plus this minus this minus this. It gives us 696,000. Annual allowance is constant, which is 309. I have added the old asset and the new asset together to have 309. So 309, we subtract it from this, we have our tax now value. Now, these other assets, motor vehicle, the old assets, when we acquired it, it has used, look at 1 year, 2 years, 3 years. In 2027, that asset would have gone to the last year of use. That is the old one. And you remember, we said you must keep tab of all these assets. The old assets, you are not going to charge, you are not going to remove 10 naira because you cannot write off asset completely in your book. You must retain something. So we are going to retain 10 naira in our books for the old assets. Now, don't forget again that this old one, the annual allowance that we've calculated on the old one is 56,250. And just like you know, annual allowance is constant. So I'm going to remove 10 naira from that in the last year of use of this old assets, 10 naira. But the new asset is still constant. That is, the capital allowance on the new asset is still constant. So I will add the annual allowance together, and I will have this value. That is 136,40, 136,240. If I subtract from this, I will have 160,210. How do I mean? This is what I'm saying. Let's do it again. So let's note. Okay. I am saying the old assets, which was acquired some years ago, we usually calculate annual allowance. Our annual allowance on that asset was 56,000 something. Was 56,250. Abi? So let's take the old assets. Let's do it alone. For the old assets, we have 450,000 minus 225 minus 56,250. We have 168,750. on the old assets. In the second year of use, we have this as our annual allowance. We have what is the balance? Someone should give me the balance. What's the balance? It seems I'm going to be calculating this in myself because you guys are not talking.
168, 750.
168
750
minus 56250. We have 112,
500.
500. In the third year of use, I'll see how my annual allowance to be this. Abi, on the old asset alone, I've ignored the fact that we bought new assets. I will see her 56,250. So this is the fourth year. In the fourth year, I will have 56,250. Now, I am now saying that the act says you cannot write off this asset entirely. You must retain 10 naira. Therefore, in this year, my annual allowance will be equal to taxing down value of the previous year minus 10 naira. This formula is in your study pack. So that means in this last year of use, I will say I will have 56,240. My balance on the old asset is 10 naira. But don't forget that we also acquired new assets. Okay? The new asset that we acquired it when? The new asset that was acquired in 2026, right? That new asset that was acquired too, we will calculate annual allowance and initial allowance on it. So on that new asset is 640. I'll remove 320, which is initial allowance. And my annual allowance that time was 80,000. You remember? So if I remove these three, I will have 240. Let me clear the board first. So if I say 640 minus 350, minus 320 rather, minus 80, I will have, what would I have? 240, right? 240. So this is in year two now. This is actually now value. In year two, our annual allowance will be constant. Abi, I will have 160. In year three, my annual allowance is constant, which is 80. I will have 80. But don't forget that this other asset that was acquired in 2004 would have used 2 years before we got to 2026. So by 2027, that is the last year of use of the asset. This is what I'm saying. The old assets that was acquired in 2024 has used 2024 year 1, 2025 year 2, 2026 year 3, 2027 year 4. In the year 4 of that old asset, you must retain 10 naira. So my annual allowance in the year 4 will now be 80,000, which is the annual allowance of the new assets plus the annual allowance of the old assets, 56,240. And I will have 136,240. That is what we have in the last year of use of the old assets. I will have 136,240 as my annual allowance. So let's go and see what happens. And that's what you have. So you will now see that we have 160,010. This 10 is the effect of the tenant that you are retaining on that asset that was disposed. This is constant. This is not constant. We need to also calculate. So the annual allowance for the old asset is constant, 125,000. But we acquire new assets. On that new asset, you calculate initial allowance, which is 90,000. That is 50% of 180, 90,000. And initial annual allowance on this new asset will be 180,000 minus 90,000 divided by 4 years, because the asset that was acquired was plant and machinery that has 4 years expiration life. So if you do that, you will get your answer. You add the answer plus 125, you will get this. Now, we acquired new asset too. We acquired motor vehicle equipment. Equipment has an annual allowance rate of 25%, but initial allowance rate of 50%. If I say 50% of this, I will have this. 25% of the difference between this, I will have this. So I'll add everything together, and bring it here. So this is the total annual allowance that I have. So, and this is the tax now value for all the assets. So we now move on to the computation of income tax liability. Before we go, you have any question, please ask the question. Victor, do you have any question?
Okay, so the assets on the second to the last column, you said the initial on the header, sir.
Yes, this
On
one.
No, it's 25.
No, that was an error. I told you at the beginning of the class that this is supposed to be 55.
Oh, okay.
Yeah.
Okay.
Victor, long time. How are you?
Fine, sir. Well done, sir.
Yeah. So we now go straight to our coming. So we go straight to our computation of income tax liability, and let's see how it goes. Now, in this year, 2024, we have an accessible profit of 1.2. Let's go back to the question. Accessible profit of what? 1.2 million. So the capital allowance that we have, that we calculate for that period, we have 1 million. Note again that this company is a trading company. And from the restriction, we said the capital allowance shall not be more than 2/3 of the accessible profits. So if we go to the accessible profits, so we have 1.2 million. Total capital allowance that we have for that period, we have 1 million. The maximum capital allowance that you can recover this year is 2/3 of this value. So 2/3 of this, you will have 800. Your capital allowance carry forward will be this number. So I'll remove 800 from 1.2 to get my total profits. And we have a tax liability of 120%, 120,000. That is 30% of this will be 120,000. Tertiary education tax will be 36,000. That is 3% of this will be 36,000. We move to the next year. We are done with that year. 2025, this company made loss. This company made loss of 700K. Therefore, we recognize the loss and we'll carry forward because there's no profit to recover it from. But don't forget that we have a capital allowance that we are bringing forward from the prior year. So I'll say capital allowance brought forward 205, 207, 201, 250. For the year, I will have 915, 250. That is the one we calculated here. This one. So I'll add this together and carry forward. In this regard, no total profit. If there is no profit, there is no tax liability that the taxpayer will pay. We move on to the next one. Accessible profit. This company makes an accessible profit of 3.5 million in the current year. So we remove the loss first because loss takes priority over capital allowance. We remove the loss, 700K. Now, capital allowance brought forward. We bring this forward. For the year, we go back to our table. This is for the year. We bring this in. We add this together. Now, if I calculate 2/3 of 3.5 million, 2/3 of 3.5 million, what would that give me? That would be 2,333,000. 2,233,000. That means the addition of these two is not even up to the restriction. By implication, we can take all the capital allowance. So I will relieve the company of all the capital allowance. I will not restrict any capital allowance here. So I'll just take everything. So my profit is 3.5 minus 700,000 minus 2.1 million. And I have a total profit of 692,250. Total income liability will now be 30% of this. I have this. Education tax will be 105 of this. And I will have this value. Accessible profits. Accessible profit is 1,250,000. Capital allowance for that period is 850. If I say 2/3 of my accessible profits, what is my 2/3 of that? 2/3 multiplied by 1,258,800. We have 238,667, which is also more than this value. We can take the entire value. So I'll restrict it and I'll calculate 30% of that. So that is that. Do you have any question?
Yes, I have a question, sir.
Go ahead.
Sir, the profit of this company, okay, as at 2026 year of assessments is 3.5, right? Why are we charging 30% tax?
Is that your question?
Yes, sir.
Thank you. Why did you ask the question? Let me know your background. Where are you coming from?
Because tax rate, the 30% is for large companies considering the profits from 25 million to 100 million. So, but the profit here is 3.5. So I don't know why we are using the 30%.
On the turnover, not the profits.
And the turnover is not given. How do we know?
Judith,
Sir?
I will give you a bonus. So, wherever you are not given any information as to turnover, assume the tax rate is 30%. Okay? We are still going to go to company income tax deeply, where we are going to discuss all this, but we have not gotten there. So, where you are not given the turnover, take the tax rate as 30%.
Okay, sir. All right, sir. Thank you, sir.
Any other
Thank you,
question?
Edith. No, sir.
Okay, we can move forward.
Question.
Okay, go
Well,
ahead.
why are we charging 3% of adjusted profit for debt instead of 2.5?
Okay, thank you. So recently, the Finance Act 2023 increased the education tax to 3%. So
Okay.
that is why.
All right. Thank you.
Yeah. Okay, we can move forward to the next one. The next question is a more detailed and comprehensive question that I want you to follow as we move on. Hopefully we should be able to finish the class before before 10 o'clock. So let's go. Prosper, can you read for us?
Okay, sir. Illustration 12. Aisha Shift Nigeria Limited commenced business as a trading company on 1st April 2023. The result of the company for the first 5 years of commencement of business were as follows. Period to 30th September 2023, 3,359,060 naira. Year ended 30th September 2024 is 23,908,620 naira. Year ended 30th September 2025 profit is 32,565,940 naira. Year ended 30th September 2026, 22,565,940 naira. Year ended 30th September 2027, 15,454,389. The company acquired the following qualifying capital expenditure. Date, that's the date for the acquiring of the assets. 1st of February 2023. Description of qualifying capital expenditure and cost. So the date is 1st of February 2023. Industrial building, 12,760 naira. Then on 1st of April 2023, plant and machinery, 4,990,000 naira. On 4th of July 2024, furniture and fitting, 2,400,000 naira. On 7th of July 2025, plant and machinery, that's another plant and machinery, 10 million naira. And then on 10th of July 2025, motor vehicle, 5 million naira. The industrial building was sold on 4th of August 2025 for 18 million naira required. Compute the capital allowance claimable by the company for all the relevant years of assessment. 2. Compute the balancing charge / allowance, if any. 3. Compute the tax liability payable by the company for the relevant years of assessment.
Thank you. So in this type of question, what is the first thing that we're going to do?
We calculate the capital allowance.
Okay, you calculate the capital allowance. But again, I've always said it that another thing that we need to first do for us to be, okay, let me ask you this question. Which year will you introduce these assets for the purpose of capital allowance claim?
2024 year of assessment.
Why?
Because the assets was acquired on February 2023, so it will be accessible to tax on 2024 year of assessment.
But don't forget that this company commenced business 1/4/2020.
The asset acquired 1st of February 2022, we assume to be acquired on the date of commencement.
Judith, times
Sure.
2 today, times 2 today, times 2 today, times 2 today. Judith is collecting gifts, Valentine's gifts from me. She has gotten it twice. Now, the first thing that we're going to do in this kind of situation is to do our asset allocation schedule that will show, because we have to bring in our commencement rule into play so that we will not make mistake of where to introduce assets. So let's go. Now, this company is just commencing operation, Abi. So we're going to use commencement rule. When the company commences operation, we say the company shall be assessed with tax from the date of commencement to 30th to the end of the company's accounting year end, Abi. So that is that. So 1/4/2023 to 30th/9/2023. We said the second year will be a day immediately after the end of the first accounting year end to the end of the second accounting year end. That is from 1/10/2023 to 30th/9/2024. Third one will be a day immediately after the end of the second accounting year end to the end of the third accounting year, which is this. And fourth and subsequent years, we said on preceding year basis. The same basis period I use for profits is what we are going to also use for our capital allowance allocation of the assets. Now, when you look at it very well, we are going to put all assets acquired within this period to be accessible to tax in 2024. So let's go and see it one after the other. This was acquired 1/2/2023. We have said in the last class, any asset acquired prior to the date of commencement will be assumed to have been acquired on the date of commencement. Therefore, industrial building will be assumed to have been acquired in the year of commencement. The next one is 1/4/2023. If you look at our basis period, 1/4/2023 will fall here, Abi. So we also say plant and machinery was acquired on that date. 4/7/2024, furniture and fitting. We'll go back to our base period. Is it here? No. Is it here? Yes. Furniture and fitting was acquired within this period. We move on again. 7/7/2025, plant and machinery 2. 7/7/2025. Is it here? No. Yes, it is here. 7/7/2025 will fall within this period, Abi, within this period. So it's there. We move on. Motor vehicle acquired 10/7/2025. Where will it be? We look at our base period. 10/7/2025. It should be here within this period. So it will fall here. We were now also told that there was disposal. We disposed an asset 4th of August 2025. We'll come here. Where will it fall here? That disposal, it will also fall within this period. So industrial building was disposed within that period in 2026 year of assessment. So thereafter, we will now go and compute our capital allowance because we now know where the assets will be introduced for the purpose of capital allowance. Sorry, guys. Okay, so we now know where the asset will be introduced for the purpose of capital allowance. So we move on. So the first one, which was acquired prior to the date of commencement, we have introduced them here based on this our table. Based on this our table. 2 assets was acquired in 2024. Industrial building and plant and machinery 1. So we have introduced them. So we calculate the annual allowance and initial allowance. Initial allowance 50% of this, Annual allowance 15% of this. Annual allowance. Initial allowance of the two we have calculated rather. Annual allowance will now be cost minus initial allowance divided by number of years, 4 years. This one, 10 years. However, the basis period that we have here is not up to 12 months. What do? We will prorate. So let's go to our calculation. So 4.9 minus 2.4 divided by 4 multiplied by 6/12. We have this value. The same thing for industrial building. We have this value. So we bring it here. I add this together, I bring it here. I add this together, I bring it here. So I have total of 5.1 million for our basis period. The next one. Tax renown value. That is this minus this minus this, this minus this minus this. We have this value. Did we acquire any other asset this year? Yes, we acquired furniture and fitting. Look at it. Furniture and fitting. In the second year, furniture and fitting was acquired. But don't forget that this furniture and fitting was acquired when the base period was 12 months. So we are not going to prorate the annual allowance. But before that, we need to calculate initial allowance. Furniture and fitting has 25% as annual allowance rates. So 25% of this, you have 600, and you need to calculate the annual allowance. That is cost minus initial allowance divided by 5 years. You will have this. Let's go and see the calculation. For furniture and fitting, we have this minus this divided by 5, we have this. Now, for annual allowance on plant and machinery and industrial building, we have to now give them a full annual allowance. Why? Because the base period that we have here is 12 months. So I'll go back to my computation and go and recalculate my annual allowance using this method. Okay? For my plant and machinery one and industrial building. So if I do that, I will have this. If I do that, I will have this for this. Why am I using this formula now? Because we believe that the basis period that we have here now is 12 months. Unlike this one when it was less than 12 months. The asset will enjoy the full basis period here. Okay? So that is that. We move on to the next one. We move on to the next one. We add all this together, we get this answer. My tax renown value is this. In 2026, we were told that industrial building was sold for 18 million. So we need to take out the tax renown value of the industrial building at the point of sales. You remember, you need to get the tax renown value at disposal. So at disposal, these are tax renown value. So we take that tax renown value, we take it out so that we don't have anything left in the books. The next one is our annual allowance for industrial, for plant and machinery is still constant. We acquire plant and machinery 2. The plant and machinery 2 that we acquired is 10 million. We will calculate initial allowance on that. We also acquired these 2. Which one is that? Motor vehicle. 5 million. So you calculate initial allowance on both. We get 7.5 million. Annual allowance on both, we get this. How do you calculate annual allowance? Cost minus initial allowance divided by number of years. This asset is used 4 years. This one we also use 4 years. That's how we got that. And don't forget, we already calculated this one initially, and we already calculated this one initially. So that is that. So we move on to the next one. My tax renown value is this value. Tax renown value for this is this value. Tax in value for this is this value. Tax in value for this is this value. In 2027, plant and machinery has witnessed its final useful life. So it has to use 4 years. So in the 4th year of use, you remember I told you your tax in value will be equal, your annual allowance will be equal to your tax in value minus 10 naira. Abi? So this is my tax in value. I'll just remove 10 naira from it. I'll remove, what's it called? I'll remove 10 naira from it, and I'll get my, what's it called? My annual allowance. So look at it. This is it. I'll remove 10 naira from it. I've got my annual allowance. We have disposed industrial building is no longer relevant. But this one, annual allowance is constant. The one we have here is what we are still bringing here. We have 1,250,000, 360, and 627. We add everything together, we have this value. Now, in 2028, which is the last year that we are required to calculate, my tax value here is 10 naira. Tax value here is 2.5. Of this one is 7.2, 720. Of this one is 1.250. Our annual allowance is constant. We bring it up again, and we subtract. We have this. Do you have any question before we move ahead? Okay, since there is no question, we'll move to the next one. Now, we want to calculate our balancing charge. Our balancing charge shall be your sales proceed minus tax down value at disposal, Abi? And our tax down value at disposal was 8 million. So I'll subtract it. I will have this. But don't forget, we said your balancing charge cannot be more than the total allowance claimed on the assets. So how do you calculate your total allowance claimed on the asset? We discussed this in our last class. You calculate your total allowance claimed on the asset by saying total cost less tax down value at disposal. So we get this. So this is the total capital allowance that we have claimed on this asset before disposal. Therefore, our balancing charge shall be restricted to the total allowance claimed on the asset, which is 3,330,211. So we have that. So that is that. So we are done with calculation of our balancing charge. The examiner now said we should compute our company income tax liability. Our assessable profit in the first year was 3,359,060,000. Capital allowance that we calculated that time, we had 5 million. Don't forget, it's a trading company. Your capital allowance shall not be more than 2/3 of the assessable profits. 2/3 of our assessable profit is this. That is 2/3 of this. We will get this value. That is the maximum you can claim. So the balance will be carried forward. Total profit is your assessable profit minus capital allowance that you can relieve. You have this. Tax liability is 30% of this. And tax education tax is 2% of this. Assessable profits. My assessable profit is 23 million from the question that we are given. Capital allowance for the year that we brought forward is this 2,2,877. For the year, the one we calculated, we have this value. So total is 5,000,480. If I say 5,000,480, if I say 2/3 of this is about 18 million. So we can relieve everything. So we will not restrict the capital allowance. We relieve everything. So total profit, 18 million. Company income tax, 5 million. Tax education tax, 717. Accessible profits. Assessable profit that we have in the question is 32 million. Don't forget that this is 2026. And in 2026, we disposed industrial building that gave us a balancing charge of 3 million that we are bringing in now. So 3 plus this will be your, what will constitute your profit for the year. But again, our capital allowance that we calculated in that year was 10 million. If I say 2/3 of this is about 28 million, which is also more than this. We don't need to restrict the capital allowance again. So we'll leave the restriction. No restriction. We will not restrict it. So we have 10 million. So we cover all the 10 million. So my total profit is this. My tax liability is 30% of this. Education tax is this. The next one is my 2027 year of assessment. Our capital allowance was 3 million. You can take everything. The same thing goes for 2015. The same thing goes for 2015. 2028 rather. So that is that. Now, if this company were to be a manufacturing company, will your answer be different? Yes. Your answer will be different because at that instance, in the first year that you were restricting the capital allowance, you will not restrict the capital allowance. You would have taken 100% of your profits. Are you getting me? If this company were to be a manufacturing company, would your capital allowance change? We are saying the capital allowance will not change. We are saying the capital allowance will not change because the capital allowance, the profit will change rather. Why would the profits that we're going to assess the tax change? Because our capital allowance, we are given the opportunity to take 100% of our profit. There is no restriction. I am not going to restrict my capital allowance. So no restriction for this. So I'll just take the entire profit. Unlike this one, that we restricted the capital allowance to 2/3 of their stable profit. This guy, for manufacturing company, no restriction. We take 100%. So the balance will be carried forward to next year, and which will be relieved subsequently. So you follow through, and you get the answer. Any question for me? Any question? In the absence of no question, we have finished capital allowance with this class. When we meet in the next class, by the grace of God, we are going to be looking at companies income tax. I intend to finish your syllabus by April. I intend to finish your syllabus by April. So that is the intent. So I intend to finish your syllabus by April, by the grace of God. So after companies income tax with you, we shall move straight to we shall move straight to petroleum profit tax. After company income tax, we shall move straight to petroleum profit tax. So with that, that is hydrocarbon tax, PIE. And after that, we would do revision, general revision. And again, if Mr. Idris does not have time to take you pioneer legislation, I will take you pioneer legislation myself. But if he has time, he will take it. So that is that. Do you have any question for me before we round off the class today? So our next class, we shall be looking at companies income tax. I intend to use 2.5 weeks or 3 lectures for companies income tax. And I intend to use 4 lectures for petroleum profit tax or hydrocarbon tax, rather. So that is that. Do you have any question? In the absence of no question, we end the class here today. Good day to you.
Thank you, sir.
So,
Sir, I just remembered something.
Right.
So in our last week class, you promised to give me something in our next class.
What's that?
I don't know. During the online class where the physical class joined um um our class, right? They joined the online class and then you asked the question, I answered, and you said you give me something the next class.
Judith, give her one out of your own.
oh yeah, take.
Oh yeah,
Take,
Judith,
give
don't
her
give me
one.
one out of your own, of our own. Don't worry. I will fulfill my promises. Don't worry. Judith has two, you have one. So let's keep tab. I'll fulfill my promises. Don't worry.
Okay, sir.
But I can still cancel it if you mess up. Hope you will not mess up.
I won't, sir. I won't.
Okay, no issues. All right, guys. Do have a nice week ahead.
So I want to collect gifts too.
Answer question, you will collect gifts. Believe.
Oh, I'll try. I'll try.
Please. Okay. Answer
Yes.
question, you will collect gifts.
All right, sir. All right, sir.
All right.
Thank you for today, sir.
All right, guys. Bye.
Bye, sir.